Hello and welcome to my take on your Daily 5 for the 12th of May. My name is Julius de Kempenaer and once again it is my turn to host the show today. In case we have never met, virtually or in person, I am a senior analyst here at StockCharts.com and the creator of relative rotation graphs. These are the swirly charts in which we can visualize the rotational character of markets. They are often referred to as RRGs. You can find my contributions in the RRG blog on the site, as well as on the StockCharts TV channel, where I host Sector Spotlight every Tuesday from 10:30 to 11 a.m. Eastern. If anything related to sector rotation and relative strength has your interest, please check out these resources, or even better, subscribe to them so you will get notified when new articles and episodes have been uploaded. I enjoy the interaction with viewers and readers, so if there is anything you want to share, please make use of the comment section below articles and videos, or simply drop me a message via email. Let's start with an inspection of the RRG for US sectors and see if we can get a handle on current market conditions. My starting point is the RRG, the weekly RRG for US sectors. And what I'm going to do is identify the sectors that are rotating at a positive RRG heading. That means into a northeastern direction, if you put it on a compass. And on the opposite side, the sectors that are moving into a southwesternly direction, if you look at a compass. Let's just go over all of them one by one. If we start with XLB, that's materials. That's a sector that's moving in a northeastern direction, clearly visible. If we go to communication services, that is southwest. That is a negative heading. We go to energy, that's also southwest. That's also a negative heading. We go to financials, we see a negative heading moving into a southwestern direction. We go to industrials, that is going sort of southeast. So that's neither positive nor negative. We go to technology, that is southwest, so that's a negative heading. We go to staples, that's northeast, that's a positive heading. We go to real estate, that's a positive heading. We go to utilities, that's a positive heading. We go to healthcare, that's also a positive heading. And we go to discretionary, and that's also a positive heading. And the next thing I did was to tabulate the results. So in the table on the left, there are the sectors that are traveling at a positive heading. And on the right-hand side, we have the sectors that are traveling at a negative heading. Generally assuming that sectors that travel at a positive heading are a positive pull for the S&P 500, and sectors that are traveling at a negative heading are a negative pull for the market as a whole. And what I did is I listed the sector, its weight inside the S&P 500, and whether it's a cyclical or a defensive sector. And if you look at the 6 sectors on the left, that adds up to a total weight of 40%. So 40% of market cap is at a positive pull. That means that the 4 sectors on the right-hand side that add up to 52% have a negative pull. It doesn't add up to 100 because XLI is excluded because that didn't fit one of the 2 tables because it's traveling at a heading somewhere between 90 and 180. So I've excluded that. These are the most well-defined trajectories. Now, so this is sort of giving me a gauge that there is more negative pull than positive pull. So it's sort of a warning signal. And the next thing I did is I listed the sectors as either cyclical or defensive. And I used the definition as it was given by MSCI based on the GIG sectors. And that's the set that's the SPDR ETFs are using. And if you look at that, then you can see that on the positive pool, there are 3 cyclical sectors. And together they are 18% of market cap. But there are 3 defensive sectors, which together are 22% of market cap. And even more importantly, there are only 4 defensive sectors out of 11. And the only one that's on the right-hand side is energy. That's only 3%. So of the 25% of market cap in defensive sectors, there is 22% at a positive pool. Now, on the negative side, we have 3 cyclical sectors that are among the largest in the universe. So it's technology, financials, and communication services. They're all cyclical, and they're all at a negative pool, adding up to 49%. So I'm trying to figure out whether this is a good way to visualize it or not. I think it makes sense conceptually. Maybe I'll tweak it going forward. But what it tells me is that the market is definitely rotating to defensive sectors. And that's another warning signal. So from the RRG to the table, breaking down market cap and cyclical defense gives us a couple of warning signals for the market as a whole. The best sector at the moment, I believe, is the materials sector, XLB. If you look at the price chart, you can see that the price is currently challenging the upper boundary of its rising channel. When we can break that and maintain levels above that upper boundary, that's usually a very bullish sign and preludes an acceleration of the rally. But more importantly, materials is breaking above its horizontal barrier in relative strength. And that's, from a relative point of view, a very important move. And it's also dragging the RRG lines back up, causing a new rotation into the leading quadrant. And that makes materials one of the stronger, if not the strongest sector in the S&P 500 at the moment. Another stealth threat could be coming from the consumer discretionary sector. It's currently listed as a positive pull because it's traveling at a positive RRG heading. But on the RRG, it's on the 100 level of the momentum axis, on the verge of crossing from lagging into improving. But when you look at the chart here, and especially at the relative strength chart, you can see that this is a topping formation starting to execute, and that positive pull is because both RRG lines are started to move higher because of this little pullback. When this remains and when relative strength drops below that previous low and these lines turn back down, then the tail on discretionary will roll over inside improving back down to lagging and start a new lag in the relative downtrend. And the fact that we're now dropping back below the previous low is not a positive call either. So this could be a very stealth threat, because if it moves over, if it starts to move in a negative heading, that means 13% of market cap in cyclicals moving over to the right hand side of the table, and that would definitely make it very, very clear that there is now in general a negative pull by cyclicals and a positive pull by defense. All of the moves and the rotations that we discussed previously are adding up and coming together in the chart of the S&P 500, and what we see there is a strong negative divergence between RSI and price over the last few weeks, with the 3 highs in price against a rising resistance line, resulting in a 3-touch negative divergence, which is pretty reliable. We're testing support at 410. If that goes, then I believe that we should see the lower boundary of that range around 400, maybe slightly lower, before the uptrend can resume. And this concludes your Daily 5. Thank you for watching. I hope you enjoyed the presentation. Please stay safe, and I hope to see you again soon at one of the shows here on StockCharts TV.
Hey guys, Dave Keller here with StockCharts.com. Thanks so much for watching our video. If you enjoyed it, and we hope you did, hit the like button right below. Also, we have so much new content every day. Consider subscribing to the channel. Just hit the subscribe button in the video or right below. Thanks for watching. Stay safe. Have a fantastic day.